us Jyotivardhan Jaipuria, the founder and MD at Valentis Advisors, joining us on the show. Jyotivardhan, hi, good to have you on the show. First up, let's discuss market itself. We were seeing a bit of consolidation, but in the last couple of days, there's a bit of spike as well, and a lot of global headlines, right, from what's happening in Israel sector as well. How are you approaching the markets right now? Putting money to work or keeping the powder dry?
Yeah, so for us, it's been like for the last few months, we've been saying this, that we think the market is going to be in a consolidation phase. You probably have a price correction and more particularly a time correction, which we'll see. So the large caps have been like that. If you see the last 3 months, the large caps have done nothing. They're more or less flattish, slightly down. And it's in the small and mid cap space, which have done well so far. But I think a consolidation is due in that space also at the moment. So we have some cash in the portfolio which we are keeping the powder dry in case there's a correction which happens. But otherwise, we are like, I would say 85% invested.
A bit cautious on the market, but where do you see value if at all? And if you had to buy something incrementally, which I think by the SIP flows, a lot of institutional investors and yourself might be dealing with this problem that the money is continuing, the retail participation as well as the participation is quite strong. Where are you putting fresh money to work? Is it financials and the other consumption stories?
Yeah, so we are also getting a lot of fresh money, and we are doing two things. One is we are staggering our investments, and in fact, we are telling investors when we take the money that we'll invest in a staggered way over the next 8 to 12 weeks, not rush in a hurry. Within what we are buying, one is it's basically our old theme still continues, which is buy local and avoid the global plays. So we continue to like the banks. I think banks is one space where things are still not overpriced by a big margin. They're still relatively decent on valuations. So banks is one space which we are doing. The other space which we have been buying is the cement names because, the monsoon season has just got over. So I think there'll be increase in cement prices in the next few weeks, and that will start playing out well for the cement space. It's an area which we like long term because one is we see a lot of consolidation happening here. So over the next 2 years, the bigger players become bigger, and that is always good for cement pricing. Plus, demand environment is very strong at the moment. So cement is the other area which we've been buying in a big way. The third has been pharmaceuticals. So pharmaceuticals been another area where we have been positive on for the last few months. The US generic pricing environment has turned better. The prices there have stopped falling, which they were over the last 5 years. And so a lot of companies are starting to look attractive here. It's a space which didn't do well whole of last year. And I think there's value here.
Okay, so cement, pharma, some of the pockets, and of course financials make it to that list. But I wonder, Jyoti, what's your take on IT? Of course, we are at the cusp of the earnings season. TCS is expected to come out with a muted side, but maybe a sweetener in terms of buyback. What should one do if they're holding IT? Should they book their profits/losses, add positions, or just maybe stay with it?
So, frankly, for us, IT is finally coming on our screen. So negative IT for the last 18 months. We have not owned a single IT share, but it's now coming on our screens because of two things. One is, valuations have become relatively better. And second is the stock has underperformed quite a bit. So now, in our screen, which is, we typically look at stuff which is non-consensus, we call it the 3Us. So that is where IT is throwing up. We're still not buying it, but for me, it will be if we get like a major price down on some bad news, then probably we'll start nibbling into IT. So it would be like, it's probably too late to sell, maybe too early to buy, but you want to buy this on some bad news.
Late to sell, too early to buy, so wait for that right time. But timing is something which is really difficult. Only the experts like Jyoti are able to manage to do that quite well. But what's your take when it comes to the real estate sector? Last couple of days caught us at least by surprise because yes, the sector has come out from a long hiatus, but nobody was expecting such a solid move. For one who has missed the rally, what should they do?
So, frankly, we also don't own real estate stocks. So we were positive on the real estate industry. We said demand environment is picking up, supply pressures starting to come down. So it's a cycle which is, at a low point of the cycle. But the way we were playing it is we don't like to buy real estate stocks only because we are very averse to debt. And we generally don't like companies which have high debt. So the way we play it is to what I call the real estate ancillaries. So we buy, the wire and cable companies to play the real estate story. We buy the tiles and the ceramic companies to play the real estate story. And that is the way we just prefer to play this whole story. But it is a sector where, the demand environment is quite strong and, supply pressure is to that extent, we'll have a good real estate environment going forward.
So that's about real estate, but do you have the FOMO of missing out?
Not really, see, because we identified this frankly, and it was just that we don't like to buy companies with high debt, and that's the reason we didn't really buy this. We bought a lot of the real estate ancillaries, so they have done actually probably better than some of the real estate stocks.
Fair enough. And you're also playing it through cement, right? So I think that makes it a bit of an ancillary there. But what about autos as well? Because that too was seeing quite a bit of shift in terms of the entire SUV phase that we had seen, the entire EV phase. Do you think bulk of that has played out now?
Yeah, so on autos, we are getting relatively more cautious than what we were, let's say, at the beginning of the year. Because to me, we've had a great surge in demand. There was a shortage of, semiconductors, and to that extent, production was constrained also. A lot of that is starting to ease off. So what I typically keep tracking is how many months do you take to deliver the car, and now that is no longer the waiting period, which was long like it used to be. So to that extent, we've had a good run in autos. We continue to own some auto ancillary stocks in our portfolio. But from now on, it's getting like it's the best phase of auto is over. And at some point now, the returns in the stock will be much more muted than what we've seen over the past 18 months. So I would say auto is getting more like neutralish for us rather than a big overweight.
Okay, Jyoti, and let me try my luck and ask you, which are the stocks that you have recently bought, or at least if you can give us some color in terms of, are these the smaller names from the new age tech world? What's been the latest addition in the portfolio?
So, nothing as exciting as the new age tech world. So we bought more, domestic sort of names, but we bought one pharmaceutical company. So like I said, we are very positive on the US generic space. So we bought a pharmaceutical company which is get more geared to the US generic space. That space is bottoming out and you're starting to see a big upturn there. So I think next few quarters, next 1 year, two, and hopefully more than 1 year also, we'll see a lot of stuff moving there. The others we bought a small, private sector bank. Again, there are some private sector banks which trade at very low valuations. In fact, some of them like trade at valuations which are cheaper than some of the public sector banks also. And some of these are starting to turn around. They're starting to do well. They were late in the NPL cycle recognition probably. But just the fact that they are so cheap means over the next 2 years, you'll get a huge de-rating benefit coming from there.
Jyoti, and a quick question, large caps or mid cap, small cap?
So, I would say the next few months, probably the large caps will do better, especially given the market environment. Over the 3 year view, I would still be more positive on the small caps. So it would be like, time yourself, buy it in dips over the next few months, because as the economy picks up, the large cap earnings is going to be much stronger than the small cap earnings will be stronger than the large caps. So that's a good 3 year story to do. But don't be in a hurry because probably over the next few months, if we get a pullback in the market, the small caps are more vulnerable to a pullback than the large caps.
Point taken, well put. Thank you so much, Jyoti, for joining us today. Appreciate you making time. But on that note, we are slipping into